Welcome to the Financial Instruments video lecture. In this lecture, we're going to be dealing with the initial and subsequent measurement of financial liabilities. So we're basically dealing with initial and subsequent measurement, like I said earlier. So with your initial recognition, it's similar to that of financial assets. I'm sure if you remember the paragraph we referred to, they say you recognize when you become party to the contract, right? So now the issue is basically how do you measure your financial liabilities. So your financial liabilities, also initial measurement is at fair value plus or minus transaction costs. So your treatment of transaction costs basically depends on the classification of your financial liability. So all financial liabilities are measured at amortized costs unless you have derivatives or other liabilities that do not qualify to be measured at amortized cost. So just refer to para 4.2.1 in your IFRS 9. That gives you guidance on measurement of your financial liabilities. So let's look at our transaction costs. So with your transaction costs, if you're measuring your financial liability at fair value through P&L, you actually need to expense transaction costs. And then if you're measuring it amortized cost, you need to actually capitalize this transaction cost to the value of your liability. Okay, so remember how we calculate our effective interest. You look at your coupon, any future value payments, any present value. So the moment that you actually incurred transaction costs, that will actually effectively affect the interest rate that you're going to be charged. So you remember your N, you'd have your N, you'd have your PMT, you'd have your future value, and your present value would, if it's at amortized cost, would then include your transaction costs, which means that your effective interest has changed, right? Which therefore means when you now get to your tests and exams and you see that there's an effect, there's a change in your transaction costs, you definitely therefore need to then recalculate your new effective interest rate to show the impact of your transaction costs on your financial instrument. So I'm sure you guys remember that we spoke about compound financial instruments earlier, where we were saying that that you might have a liability. You might have an instrument that has both the liability and equity component, right? So what we're saying is you've probably issued an instrument, right? And you then look at and then the value of the contractual obligation that you have to pay. If you present valued it and you looked at the process that you received in relation to that instrument, it's actually less, which therefore means you have an equity residual, therefore you have a compound financial instrument. So I want us to just look at convertible debentures, right? If they're mandatorily convertible, you're saying that at the end of the period you will have to convert your debentures into shares, right? You can see that your coupon is probably like contractual obligation to deliver cash, and you have a liability in that case. And the forward gives rise to an equity component because you're expected to convert your principal amount into shares. And then there are times where you have debentures that are convertible at the option of the issuer, as well as at the option of the holder. So now, in determining whether it's a compound financial instrument, you need to obviously first look at, do you have a contractual obligation to deliver cash? And then if you do have a contractual obligation to deliver cash, compare with your proceeds and see if you probably have a residual interest that is equity, right? So with your different convertible debentures, you need to identify components which have the liability and discounted market rate of a similar instrument without conversion option to actually get the value of your liability. So I want us to go through an example where we actually measure like the value of our financial liability and that of our equity. So we have three examples where Macaroni issues 101,000 mandatorily convertible debentures with an annual coupon interest rate of 6% per annum, and the debentures are convertible into 20,000 shares of Macaroni 5 years from now, and proceeds received are 98,000. So in this case, we can say we have received 100,000 and we have received 98,000, and we have to convert debentures to 20,000 debentures. So in that case, you can actually see an equity residual, but then there's also coupon interest that have to be paid yearly, which therefore means that you have a contractual obligation to deliver cash. So you have your financial liability, then your equity component, and then with the following one, we're saying debentures are convertible at the option of the holder, and they're given the proceeds amount. So in this case, we're saying contractual obligation to deliver cash, yes, because there's the coupon as well as the debentures. If the holder decides they can come and claim cash, so we need to calculate the value of our liability in that case, and also see if there's any evidence of a residual between your process and the present value of your liability. If there is a community of equity, then we have also in example 3 the debentures being convertible at the option of Macaroon. So in that case, we also have we're going to look at the liability, right? And then say come up with our liability and also look at, is there any evidence of any renewal? So I want us to go through the different examples. So in our first example, our proceeds were 98,000, period was 5, payment 6,000, interest of 7%, and future value is 0. So in that case, what is our present value? So the present value will give us the value of our liability, which is 24,601. Our future value is 0 because we're saying we're not picking out any cash. These debentures mandatorily have to be converted into cash. And then, so since there's a residual between our proceeds and the value of our liability, we definitely have a liability component there. Let's move on to scenario 2, where we're saying we received 102,000. Our inputs have remained unchanged except the future value, because we're saying that there's a potential that we might have to pay out the entire 100,000. So in this case, we're saying the value of the liability is 95,900, and our residual is therefore equity, which is 6.1. We do the same for option of the issuer. So in this case, we're saying what is our contractual obligation at this date? There's the 6,000 and no fair value because we're the ones holding the instrument. We do not have a contractual obligation to deliver cash in relation to the capital component. So our value of our liability is 24,601, and the equity component will be 70,399. So in this case, can you see that in all three scenarios, we have a compound financial instrument measuring the value of the liability? I'm sure you should be able to do this because you know how to compound, and then the equity is just the residual. So please take note that your classification is not changed due to a change in the probability of conversion. So it's probable that we will convert to equity instruments at the beginning, or at the end you then say it's not, as you move you say it's not probable. That will not change how we classify our instruments. So what happened to our transaction costs? Well, we have a compound financial instrument. A portion is equity and the other portion is a liability. It therefore means that you need to split your transaction costs in proportion between your equity and your liability. So this therefore decreases the value of the equity as well as the financial liability. And remember what we're saying about the moment you take note of your transaction costs, it means that your present value has changed, which therefore means your effective interest will also change. So with your liability, there's an issue of changing credit risk. So when you're measuring your liability, you need to actually separate any change in the discount rate of the issuer to credit risk and just a change in the interest rate, right? Because these are going to actually be treated separately. So your change in credit risk will go directly to OCI, and then the change in interest rate will be in P&L. So this is best illustrated in an example. So we have Macaroon, which have irrevocably designated its liability to Greenbank to be measured at fair value through P&L. The loan to Greenbank pays quarterly interest at 9% per annum and is repayable on 31 December 2018. On 1 January 2014 and 31 December 2014, Macaroon's credit rating was AAA, resulting in a discount rate for Macaroon of 9%, and the loan to Greenbank is a standalone liability. So how do you initially recognize? We say at fair value. So we've got our fair value of 22 million. You debit your bank and credit your long-term loan. And then 3 months later, we're told that Macaroon's credit rating then drops to a B, resulting in a discount rate of 11% for Macaroon. The loan to Greenbank remains a standalone liability, and the risk-free rate is now 8.2%. So can you see that now we have a change that is attributable to the risk-free rate, and then a change that is attributable to your credit risk. So we're saying if the change attributable to your risk-free rate will be treated as a P&L item, and the change attributable to your credit risk will go to your other comprehensive income. So calculating the change in the value of your liability and what should be allocated to credit risk and what should be allocated to risk-free rate is. So in this case, please take note of the initial risk-free rate as well as the credit risk, and then the subsequent risk-free rate as well as the credit risk. So in trying to come up with a change in credit risk, you need to actually isolate or ignore the impact of your credit risk and come up with the value of your liability, not taking into account your credit risk. So it will be your 8.2% plus the 2%. This, because in this case we're just assuming that our credit risk hasn't changed if we add the 2%, right? So if you get this amount should give you fair value, not taking into account credit risk, right? Okay, so I just want us to talk approach. If you're trying to calculate your change in credit risk, your first step is to actually come up with the change in fair value for your financial liability. So it's going to be your 8.2% plus your 2.8%, and you calculate the fair value change based on that, right? And then moving on from that, you now need to separate it into market movements, change due to market movements, and change due to credit risk. So to get your change due to market movements, you need to hold your credit risk constant, and you're saying, I'm ignoring the impact of the change in credit risk. I'm going to take my market movement, which is 8.2, and keep my credit risk at 2%. And then you then compare that to your carrying amount and to your carrying amount. And then the value that the difference that you're going to get there is going to be a change that's going due to market movements. And then the residual is your change in credit risk. So let's get into our example. So first we said that we need to come up with a fair value of the loan, right? Taking into account changes in market movement as well as change in credit risk. So this is basically your 7% plus the 2% divided by 4, since we're measuring in quarters. And this is your 8.2% plus your 2.8% divided by 4, since we're measuring in quarters. So you then get your fair value. So your fair value adjustment will be your 22 million minus the 2662. And this fair value adjustment has not been separated to say this is in relation to credit risk and this is in relation to market movement. We're saying this fair value adjustment takes into account both credit risk and market movements. So we then we then need to take note of our payment, which is 2150, which is 495,000, to come up with the carrying amount of the loan, since we hadn't taken into account the payment. So the carrying amount of the loan is therefore 21,505,000. So we say our 21,505,000 compared to the present value of 20,662,763, and our fair value adjustment is 842,237, right? So once we have that fair value adjustment, we now need to split it into components relating to credit risk and a component relating to market movements. So take note of the coupon payments. I'm sure you know how to do your journals, and also come up with a fair value adjustment. But then this is just going to P&L, but this amount should be OCI and P&L like the narration correctly says. So we need to split this into fair value relating to market movements and fair value relating to change in credit risk. So to do that, like I said earlier, we need to isolate the credit rating effect. So we're going to take our 8.2 plus 2%, which is the initial credit risk before the change in credit risk, and then we calculate our new fair value and compare to the carrying amount that we came up with earlier of 21,405,000. So we get 21,185,000. The difference between these two relates to your market movements and should go to your P&L. So the 319,173 is going to go to your P&L, and then you're going to say your 842 minus the 319 to get the amount that's going to your OCI. So can you say your difference between the 842,237 and the 319,173 is the one that's going to your OCI? So calculating change in credit risk is pretty simple. So what is important to note is you first need to actually come up with your carrying amount. Your carrying amount for the financial liability, and like using the old rates, and then come up with your new fair value, taking into account the change in the rates both. So you're going to take your change in market movements plus change in credit risk to come up with your fair value. right? The change that you're going to get is your entire fair value adjustment to the financial liability, right? And then after that, you then need to split it into P&L and OCI. And to do that, you need to hold your credit risk constant, like ignore the effect of your credit risk. So take the original credit risk before the change and then take the new market related movement and then calculate your fair value compared to carrying amount of the liability. That's how you're going to get your fair value adjustment. Now that goes to P&L and then the balance goes to your OCI. Thank you for your time and I hope this recording was helpful.